So today I'm doing the UK stocks I'm buying May 2025 edition. This is a monthly series that I do on the YouTube channel where I go through all the stocks that I bought and sold between the 1st of April to the 1st of May. Now, I've done this series for many years on the YouTube channel, so you can go back 4 or 5 years and see which stocks I bought previously, and you'll be able to see if they work out or not, and it just keeps up that transparency. It's probably why this video series always does so well. There's 9 stocks that I bought, so normally I spend 5 to 10 minutes on every stock, but just because there's so many, I have had to squeeze it down to like 3 minutes for each stock, otherwise the video will end up being like an hour long and nobody wants to listen to me for an hour, so hope that is okay. And as well as that, the microphone also does cut out when I do all the stock information, so I've tried to edit it so it does sound okay, but I wasn't going back and recording another 40 minutes again. So yeah, hope that is all okay as well. Apart from that, hope you enjoyed the video. If you're new around here, subscribe, hit the like button. Let's get started.
So like I said, the reason why I was buying a lot of these stocks is because of the so-called Liberation Day. The tariffs that were going on caused a lot of stocks to dip, and yeah, that's why there was so many stocks bought. If you do want to see what I'm buying and selling in real time though, the place to be is on the Patreon, £6 a month or £60 for the full year. There's the link in the description. If you join through there, you get to see what I'm buying and selling in real time, and as well as that, I post at least 2 exclusive videos a week on there as well, and a Discord of 600 members to talk to about stocks, including me, but there's even some people on there that are better at the stock market than what I am. As well as that, if you do want to start investing, or you want to use, in my opinion, the best investing platform out there, the one that I use is Trading 212. There's a link in the description. If you join through the link in the description, you can get a free fractional share worth up to £100. Let's get on to number 1, JD Sports. I think you all knew this was going to be on the list. My largest UK holding right now, and yeah, I have gone very overexposed to JD Sports, but I just went risk to reward. Now, I've got to be brave. You know, the saying "fortune favors the brave" kind of went on with JD Sports, and as I saw that stock start dipping into the 61p range at the start of this month, I went, okay, this is one that I'm going to be starting to buy on this dip, very aggressive. And since then, to be fair, the stock has rallied up. The stock is up 25% since that time frame. So I am very happy that I have been aggressively buying that dip at the time frame. And I'll show you how cheap it went in a second. Now, JD Sports, probably most of you guys in the UK know about this because it's nearly on every high street. But the big thing that they are doing at the moment is not just the UK side of it. They've expanded into Europe, and that's how they're going to get a lot more growth, is expanding into Europe. And as well as the US can potentially be their biggest market going forward. You can see here when they launched in financial year 19 with the Finished Line brand, and now you can see that they're up to 6 billion with the brands that they have across the US, and there's still potential for them to keep expanding going forward. Now, it's been a tough time for JD Sports at the moment, but when you compare it to other stocks like Nike, for example, and you look at how much they've been hurt during this time frame, revenue down 9%, you have net income down 32%. I think when Nike rebounds, someone like a JD Sports will rebound as well. But even during this time frame when Nike have been struggling, JD Sports have actually financially been doing quite well in a downturn. So for example, we've seen the past performance being amazing, and even what was supposed to be a bad year for JD Sports, they've gone from 2.5 billion in revenue up to 11.4 billion in revenue, which isn't too bad at all. If you look at the EPS as well, EPS has been ticking up nicely, and that means right now that if you look at Google is actually showing you the wrong PE on JD Sports. It's actually not 12 times earnings. JD Sports is actually 6 times earnings right now, which should not happen for a company like JD Sports. This is one of the best retailers out there with one of the best track records of financial performance on the UK markets. Look at this past performance here, absolutely amazing. And as they open up stores, this is only expected to continue. This stock should be trading at least 12 times earnings, and that is forecasting no growth in there. That's already double the share price from where it is right now. They have a cracking balance sheet. Simple Wall Street hasn't updated, but this debt, a majority of it has actually been paid off at the moment. And insiders have been buying, which is probably what you want to see with the likes of the chairman of the board buying some shares at the moment. We've also seen the CEO buy some shares recently as well. Yeah, this one just went way too low, and it's having a little bit of a bounce now, but I even think from these levels, JD Sports could go a lot higher from where it is right now. Next one was Gaming Realms. So Gaming Realms, once again, has had a bit of a rally since I did start buying it, up 21% in the last kind of couple of weeks. But I started buying Gaming Realms because they came out with a fantastic trading update, and yet the stock hardly moved on the share price. Now, if you don't know what they do, they provide some games to some of the biggest sports betting or iGaming players out there, like William Hill, DraftKings, Sky Bet365, and they do either a developer and licenser Slingo, which you'll see the Slingo games on a lot of websites, and also Real Money and game distribution platform as well. Now, what they did recently financially was amazing. Revenue grew 22%, and they are now, because they don't have to put a lot of the costs in place, they're actually seeing their profit margins expand. So that's an amazing thing when revenue is growing, but profit is growing even faster because the margins are expanding. An example of that is adjusted EBITDA was up 30%, profit before tax was up 61% as well. So they're getting metric expansion. Now, the space that they're operating in this sports betting and iGaming space, there is major growth drivers in the US. We've covered this on the YouTube channel multiple times before, so I'll keep it nice and brief. But this is the investment case for the growth of the iGaming in the US. We're going to see from 2024, 2025, depending if you go on base case or bull case, but on bull case, we could easily see over double up in the next 2 or 3 years on iGaming as more states come online. Even on the base case scenario, we're going to see nearly double up of the growth. This is one of the clearest growth areas, TAMs in the market, and I think if you don't own an iGaming company, I think that is a big mistake. And when I look at someone like a Gaming Realms, is they financially keep delivering, yet realistically the share price hasn't moved that much and the valuation is very cheap. For example, if we do look at the past performance here, look at this past performance of this revenue growth and this profit margin expansion that's going on at the moment. Absolute amazing balance sheet here, there's no debt on there. Very healthy cash balance as well. And that's why they're also able to just do what they've just done and announce a share buyback, which is obviously great. And even right now, if you look at the numbers they're about to do from 2025 to 2026, we're currently trading around about 12 times earnings. That's going to drop down to 10 times earnings, which is just incredible for when you look at a company that's trading 10 times earnings and you look at the numbers that they've just come up with 20% growth, profit expanding more than that. Very, very good numbers here from Gaming Realms. Number 3, Watches of Switzerland Group. So I have started buying back into this one. This was a stock that I used to own. I bought it as a bit of a turnaround play in 2024. The stock ran up a good amount and I decided to lock in my profit. Since then, the stock has dropped down 39%, and from its all-time highs in 2021, it is actually down 75%. So I actually don't really know why it dropped. So that's why I'm buying it, because I don't think it deserved to drop. Obviously, there's a lot of talk about this tariff situation at the moment, but even with the tariff situation at the moment, it looks like these tariffs, there's going to be some sort of trade deal sorted out, so they probably won't be affected by it. Now, the reason why Watches Switzerland is struggling in the moment is you probably see the brands around the UK. There's got a lot of high street retailers in the UK. But what happened is in 2021, 2022, is Rolex watches peaked. Everyone had free money from staying at home, spent all the money on these watches and lower interest rates. And then what happened in the next few years is the demand that got pulled forward. Obviously, it affected them. Interest rates going up. People had less spare money because of the inflation issues that are going on. So we had a bit of a natural coming back into where Rolex prices should be. Now, historically, Rolex prices always go up. So in my opinion, we will see this at some point, this Rolex price index hit all-time highs again. We will see when that happens, but we clearly see a U shape now starting to come in the Rolex prices. Now, as well as that, what's going to help Watches Switzerland grow is they're now expanding into the US. So you can see here from financial year 2019 that the US market made up 24%. It's now going to go to 45%, as you can see here, which is great because the US tend to spend a lot more money on some of these products that they have. And you can see here the revenue is going to go from 120 million to 870 million. And as they continue expanding through this US, this is going to give them more profit and revenue growth. Now, this company has historically done quite well if you look at the past performance. Very good growth from revenue and decent profit margins. Balance sheet wise, there was a little bit of an acquisition here, which did make the balance sheet a little bit worse, which hopefully they sort out, because when they do normally go back to the good amount of profit they generate, they should be able to pay that off as they generate that profitability again. But once again, what you want to see? Some insider buying. The chairman of the board on the 11th of April bought some shares, so only a couple of weeks ago, and bought around about 100k worth of shares. So that's another bonus sign for me that, okay, that's a nod of approval. And as well as that, if you look at the company now, it's currently trading around 8 times forward earnings. For a company which is the only way that will give you access to investing into Rolex directly, because Rolex isn't a public company, 8 times earnings is a bit too low. I would say this company should trade somewhere between 15 to 20 times earnings. So yeah, some nice metric expansion possibly there as well. Now, by the way, if you do like the platforms I am showing you in this video, like the insider buying on Watches Switzerland on Simple Wall Street, there's a link in the description that will give you 30% off and a 14-day free trial. And if you want to try Stockopedia as well, there's a link in the description for that, and that will give you 25% off as well. 2 platforms that I personally use a lot when I do my investing research. Now, moving on to the next one, Hollywood Bowl. So once again, this one having a cracking rally in the last kind of couple of weeks. This was my largest position for a good while, but I haven't bought it really. I've kind of been not touching it. I've been focusing on other stocks like JD Sports, for example. But now I just looked at it and I thought the stock had a little bit of a tumble, as you can see here, went too low. They brought a very good financial update out, and I thought, you know what, the valuation, how good this update is, I'm going to have to start buying Hollywood Bowl again. Once again, us guys in the UK, we know about this one. You probably have one near you. You go to Hollywood Bowl, you do the bowling, you might even go to get some food and drink, and you might even go to the arcades that they have on a lot of the sites. Now, that market is getting a little bit mature at the moment now, so the growth is slowing down. I say slowing down, 4.7% is still not bad at all. But what they're doing now is they're going to expand into Canada. That's their next growth driver. And you can see here, Canada revenue was up 40.8%, which isn't too bad at all. And on a like-for-like basis, up 13.6%. So as they do a replica of the UK business into Canada, I think this company will do very well. Because if you look at what they have historically done under this old management team, the execution has been amazing, with great profit growth, great revenue growth here. They sit on a pretty good balance sheet, as you can see here, no debt on there. A nice bit of cash balance as well. And as well as that, there has been some insider buying going on in the last couple of weeks, which once again is a great sign to see here. If we do look at what they currently trade at, currently around about 13 times earnings. So obviously, when I was buying this, it was a little bit lower. It was actually in 11 times earning range. For me, I think Hollywood Bowl should trade somewhere between 17, 18 times earnings. So when it was on that dip, I thought I'm going to have to buy some Hollywood Bowl, and that's what I did. Moving on to the 5th stock, which is Warpaint. So this has had a bit of a rally, but not as much as some of the other stocks that I previously mentioned that I have been buying in this last month. Now, I'm sure most of you guys are aware, Warpaint, they sell a lot of beauty products. They sell dupes, copycats of really popular, expensive products. And then they realize, actually, this is actually a really good brand, good quality. I'm going to buy some of their other products as well. And they've also made a recent acquisition of Architects as well, which should add into the portfolio. Now, they brought out some recent earnings, which the market didn't seem to love, which was strange to me, because when I was looking at Warpaint's earnings and I was thinking, okay, this was 14 times forward earnings, these are very good financials for a company at 14 times earnings. Revenue growing at 13%, gross margins expanding, so that means profit is going up higher than the revenue. So if you look here, adjusted profit before tax was up 33% as well. The expansion into the EU is still going well with 22% growth. The US revenue as well, growing at 19% as well. And as well as that, they gave a little bit of an outlook into Q1, where they said that the first 3 months have increased 14%. And when they look at margins are also better as well than achieved in the full year 2024. So once again, we're growing at 14%, but profitability is growing even faster than 14% because margin expansion is coming in. So that is going to be what, somewhere between maybe 15, 16%. So 15, 16% profit growth on a company at 14 times earnings. Pretty good if you ask me as well. And financial health wise, another cracking balance sheet, no debt on there, nice healthy cash balance. So they can go either pay a dividend, because they do actually pay a little bit of a small dividend at 2.8%, or they can go do some acquisitions like they did with Architects, and hopefully that will mean that they do very good growth and profit from acquisitions that they make. And you can see here they're expected to have a good growth year and a good profit year this year as well. Now moving on to the sixth stock on this list, one that actually hasn't done that well since I bought it, which is Mobico. I bought a little bit before earnings, so that was a bit of a bad purchase, and then I bought after the big drop that it did have. So I bought both sides of this stock move, as you can see here. I'm buying this as a bit of a turnaround play. There is a few issues with this one, but I feel like this drop is a little bit too much at the moment, and I am buying in. Now, there is a little bit of a risk with the balance sheet. The balance sheet is a little bit of a mess, as you can see here, not looking pretty at all. So I'll just point that one out. That is the reason why the stock has fallen so low. But there's been a lot of news stories at the moment, so I've kind of got them as a whole here. So they brought out that they were selling off the American school bus. The market seemed to think that it wasn't for enough money, so that's why it threw it down. There's also a couple of financials in there saying that they're going to be at the lower end of guidance, just to top the market off a little bit more, and that probably pushed it a little bit lower. But overall, I thought they were in the full year guide, which is okay. They were financially moving up in the right direction, and the school bus sale, in my opinion, was only just slightly below what I personally thought it was going to sell for, so I wasn't particularly too bothered about that. Then they brought the full year results out, and the market didn't seem to like the full year results, so threw it down again on that one. Then the CEO decided to step down, which I think is correct, because when you have brought out the financials that you have and missed the targets a little bit, and your share price is created like this, I think you've got to go. So that was probably the right direction, and let someone else come in and see if they can turn this business around. And then what has been probably one of the most successful part of the business, which is the ALSA, the part that's actually been doing really well, good growth and good profit. The actual COO and the ALSA CEO actually then bought a ton of shares, which is a very positive sign. Now, my thinking is that if they're able to manage, the company has really struggled since the COVID situation. Even though revenue growth has been good, they've not been able to get to the same levels of profitability with a lot of the inflationary impacts at the moment. So I'm hoping that they are going to get somewhere to where they used to be at, even if it's even half of what they used to do. 70 million on 186 million market cap is obviously looking pretty good, even with the issues that they do have at the moment. And if we do look at 2025's numbers, we are expected around about 70 million actually forecast for the next year. And if they do hit that number, that will actually put them around about 2 times earnings. So you can see here, this is a battle at the moment going on, that the market is going, nope, the balance sheet's a mess, this isn't going to end well. Or you look at it from a turnaround point of view and go, you know what, I think they can get back to the levels of profitability they used to do, and at 2 times earnings you'll get rewarded if it does happen. That is basically the story at the moment with Mobico. Moving on to the next one, pretty much a pure dividend play, which is Legal and General. They give me around about a 9% dividend yield at the moment, and for me that's something quite nice, to have that consistent dividend income. Sometimes you don't appreciate these sort of stocks until you go into a market where share prices keep going down, you need a bit of money, but then you get that 9% dividend yield. It's a nice little income that you know you're going to get. Now, Legal and General obviously provide ISAs, insurance, pensions, retirements, and later life mortgages as well. So they have quite a broad offerings that they have, and they have a good track record as well. Historically, pretty good at delivering their profitability. Balance sheet wise as well, not too bad on the balance sheet. And the big thing you're getting this from is the dividend. Historically, increasing that dividend year after year, and obviously, the S&P normally returns 9% a year, and you're nearly getting that with Legal and General, and hopefully you get a little bit of share price appreciation as well. And right now, it's been on a little bit of a dip at the moment, so if you can get back up to the £3 range, that would be also a little bit nice to get that on top if it was to have that bounce up as well. A couple of insider buys going on as well, which is obviously great to see with Legal and General. So a nice little dividend stock there. Moving on to the next one, which is Zotefoams. So this is a stock as well in the last month that hasn't really done what a few of the other stocks on my stocks I've been buying have done, which is bounce up. This has kind of stayed pretty flat at the moment. It does pay a little bit of a 3% dividend yield at the moment. I think the stock is down because there's a lot of fear on the Vietnam tariffs, but I think there'll be a deal out sometime soon, so I don't see them being affected. But obviously that's one thing that could affect them with the partnership that they have with Nike and the foams that they provide to Nike. Another thing that's kind of spooked the stock at the moment is that they brought in a new CFO, which was Nick Wright. The market didn't seem to like it. The market maybe be thinking that he had associations with S4 Capital, which hasn't done that well in the last few years. And any of you guys that have followed the YouTube channel for the last few years, you might remember S4 Capital. And yeah, maybe that's the reason why that they've kind of threw it under the bus at the moment. But the future still looks good for Zotefoams at the moment. In the last year, revenue was up 16%, operating profit was up 20%, and basic EPS was up 37% as well. The future looks good with their partnership with Nike in the HPP products as well. And if they're able to hit the longer term guidance that they're aiming for, which is 200 to 220 million revenue and profit, operating profit and profit margin expansion. This should do really well at the moment because it is currently valued at 8 times earnings. 8 times earnings for a company that will be growing at a CAGR of 7% and a operating profit CAGR of 17% seems fairly cheap. A pretty decent balance sheet as well. They've got a debt to equity of around 31%, and there's been a couple of little nibbles going on the insider front as well. So I'm a big fan of Zotefoams, and that takes me on to the last stock that I've been buying, number 9, which is Audio Boom. So yeah, this has had a bit of a tough month at the moment. Probably the reason why is because they are in the advertising space, and as we know, as soon as the recession fears start coming around, normally advertising stocks are one of the first ones to get hit. So that might be the reason why. But they are a producer of podcasts, so they link up the creators to advertisers and then put them to the audience. They are at the moment growing at a CAGR of 38%. They do expect to be somewhere near the industry CAGR of 22% revenue growth at the moment. There was a bit of a dip during the downloads because of a change to the iOS on Apple that it did affect them. And even with that, they've still done pretty well recently as well. Looking at some of the new products. So they brought a new product out, which is called Showcase. Now, this Showcase platform is a higher gross margin platform. So it's currently 31% gross margin, higher than the other ones, and uses a bit of AI to help with those gross margins. Now, this is becoming a bigger part of their revenue mix. As it becomes more of a bigger part of their revenue mix, they're going to make more profitability as well. And you can see that change from 2021 to 2024. So there's also going to be big growth on this platform here. Okay, balance sheet. I see a few people criticize the balance sheet. There's no debt on there. 3.8 million of cash, which isn't too bad for a 53 million market cap. There's been a lot of insider buys over the time frame as well from the chairman of the board. He's been regularly buying every kind of 2 weeks here. And if you look at the forecast, the forecasts are actually only expecting about 10% growth. As we've seen before, they mentioned a 20%, 22% CAGR growth. So that's higher than what's been forecast. And as well, currently 20 times earnings. I think that when some of these Showcase starts ramping up as well, I actually think the profit will come in a little bit higher. So I think actually realistically, 21 times earnings, it'll actually be a lot lower than that as well going forward. So yeah, I'm a big fan of Audio Boom. That takes me on to the one stock that I did trim. I did trim it a couple of times, and you probably noticed it wasn't on the buying list. And the reason why is because it's just rallied up so much. B&M, I did trim my B&M position. It has had a cracking month, up 23%. The reason why I did trim the position is just because I bought so much. I bought so much when the stock was having this big dip here, especially during this time period to get my average lower. And my allocation just got a little bit too big. And now that it's gone up, I thought I'm going to just balance the position out a little bit where I'm a bit more comfy with my allocation just in case anything was to go wrong. So I did just do a little bit of a couple of trims on B&M. So with dividends included, I did take a 20% profit trim, a 16% profit trim, and a 10% profit trim as well. Just as this kind of spike just kept going up and up and up. So yeah, I just had to balance the position after buying in the dip so much, and now my position is in the green. Get some short-term rewards, get a little bit of cash, and I can put that into some other stocks that obviously you can see on this list. Those are some of the other stocks that I've been buying that have been mentioned just previously, and yeah, use that cash into other places. And that is everything, guys. A lot on there, and apologies if there was some brief covering of some of these stocks. Let me know if there's any in particular that you'd like a 20-minute video on with some numbers run on them. But apart from that, have a great bank holiday weekend and a rest of your Sunday night, and I'll probably see you tomorrow for a preview on what is going to be another mega week for the stock market. See you in a bit, guys.